In 1929, the stock market crashed 89%. In 2008, people lost half their wealth. In 2020, trillions disappeared in weeks. But here's what almost nobody talks about. While everyone else was losing money, some assets were going up, not just surviving, doubling, even tripling. And today, almost nobody owns them. So the real question is, what are they, and why are you not invested in them? Hi, I'm Gavin, and I spend a lot of time analyzing what actually happens to money during market crashes. And by the end of this video, you'll understand why some people lose everything, while others come out ahead. So please subscribe, like, and comment if you'll like this video. To understand this, we need to step away from charts for a second and look at behavior, because this isn't just about assets, it's about how people think. Let me explain this with a simple story. Imagine two investors, same age, same income, same starting point. They both begin investing with the same goal: build wealth over time. The first investor follows the standard advice. He buys index funds, he invests consistently, he avoids trying to time the market, he believes in long-term growth, and for a while, it works. His portfolio grows, everything looks good. The second investor? He also invests in growth, but he asks one additional question: what happens when the cycle turns? So he studies history. He looks at 1929, 1973, 2008. He doesn't just look at what went up, he looks at what didn't go down. At first, this seems unnecessary, because during good times, everyone looks smart. But then the environment changes. The market starts falling. At first it's small, 10%, then 20%, then 30%. The first investor tells himself, this is normal. He holds, then it drops further. Now fear starts to set in, because it's no longer theoretical, it's real. He sees his portfolio shrinking, and more importantly, he has no strategy for this environment. The second investor, he experiences the same decline in part of his portfolio, but something different happens. Not everything is falling. Some positions are stable, some are rising. Not dramatically at first, but enough to offset damage, enough to reduce panic, enough to give him clarity. And that changes everything. Because the biggest difference in a crash is not returns, it's behavior. One investor is reacting emotionally, the other is acting strategically, and over time, that difference compounds. This pattern isn't hypothetical. It shows up repeatedly in historical data. During major downturns, different asset classes behave in completely different ways. But most investors never see this, because they're only exposed to one side of the market: growth. And that's where the real risk is. If you zoom out across multiple economic crises, a pattern becomes clear. Crashes are not random. They follow structure, and understanding that structure gives you an advantage. Every major downturn tends to follow three phases. Phase 1, the breakdown. This is where everything starts to crack. Markets begin to decline. At first slowly, then faster. Liquidity tightens. Confidence drops. Assets tied to economic growth, stocks, speculative investments, start falling together. And this is where most investors feel trapped. Because everything they own is correlated. Everything moves in the same direction, down. Phase 2, the shift. But this is where things get interesting. Because while prices are falling, money is moving. Not out of the system, but within it. Large institutions don't exit markets completely. They rotate. They move capital into assets that historically perform better under stress. Assets that provide safety, stability, scarcity, and this movement creates divergence. While some assets continue to fall, others begin to rise. Phase 3, the transfer. This is the phase most people never notice, because it happens quietly. While the average investor is focused on losses, capital is being repositioned. Assets that benefit from crisis conditions are accumulated. And when recovery begins, the difference becomes obvious. Some investors are still trying to recover losses. Others have already moved ahead. This isn't luck. It's not timing. It's understanding how money flows during stress. And this is exactly where the four assets we're about to discuss come in. Asset 1. Gold mining stocks. Now let's start with the most explosive, and probably the most misunderstood, asset on this list. Gold mining stocks. Most people think of gold as just a safe asset, something you hold when things go wrong. But what history shows is something much more interesting. Because during major economic collapses, gold itself holds value. But the companies that produce gold can increase dramatically. Let's go back to the Great Depression. Between 1929 and 1932, the stock market collapsed by nearly 89%. Entire sectors were wiped out. Banks failed across the country, but one company, Homestake Mining, rose about 48% during the crash itself, and then went on to gain over 580% in the following years. Think about what that means. While most investors were being financially destroyed, this asset wasn't just protecting wealth, it was multiplying it. Now fast forward to the 1970s, another period of economic stress, high inflation, oil shocks, market instability. The S&P 500 dropped nearly 48%. Gold mining stocks up around 193%. Again, completely opposite behavior. So what's actually happening here? It comes down to a simple but powerful mechanism. When confidence in financial systems drops, people move toward assets that cannot be printed. Gold becomes attractive. Its price rises. But mining companies don't just benefit from that price increase. They amplify it. Because their costs, labor, equipment, operations don't rise as quickly as gold prices. So when gold increases, profit margins expand significantly. This creates leverage, and that leverage is what drives these outsized returns. But now we need to talk about the part most people ignore, because this is where the nuance matters. Gold mining stocks are not stable. Outside of crisis periods, they can collapse. From 2011 to 2015, many gold miners dropped over 70 to 80%. They are volatile. They are cyclical. They are not something you blindly hold forever. And that's exactly why most investors avoid them, because they don't behave well during normal conditions. But that's also what makes them powerful. They are not designed for normal markets. They are designed for stress environments. And historically, when that stress appears, they've been one of the strongest performers. Asset 2. Long-term treasuries. Now let's move to something that feels almost boring by comparison. U.S. government bonds. If gold miners are explosive, then treasuries are the opposite. Quiet, stable, predictable. And that's exactly why they matter. Because during a crisis, predictability becomes valuable. Let's go back to the Great Depression again. While stocks were collapsing, long-term Treasury bonds still delivered positive returns overall. Not huge gains, but stability. And in a market where everything else is falling, stability is powerful. Now jump to 2008, one of the most severe financial crises in modern history. Banks failing, credit freezing, global panic, stocks dropped dramatically, but U.S. Treasuries returned about plus 20% in 2008 alone. Again, opposite direction. So why does this happen? It comes down to one concept: flight to safety. During uncertainty, investors don't just look for returns, they look for security. And globally, U.S. government debt is considered one of the safest assets. So capital moves there, massively. And when demand increases, bond prices rise, yields fall, existing holders gain. But here's something important. Most people misunderstand. You don't make money from bonds by holding forever. You make money when rates fall and prices rise. That typically happens during recessions, financial crises, deflationary environments. But there's a catch. Bonds do not perform well in high inflation. If inflation rises rapidly, bond values can fall significantly. We saw that recently, which tells us something critical. There is no single perfect asset. Each asset performs under specific conditions. And that's why diversification across different crisis types matters. Asset 3. Farmland. Now we move to one of the most overlooked and least understood assets. Farmland. This is not something most people even consider. It's not talked about in mainstream investing. It doesn't trend. It's not liquid. But historically, it has been one of the most resilient forms of wealth. Let's look at the data. In the 1970s, U.S. farmland prices went from around $197 per acre to about $737 per acre. That's a plus 274% increase. Driven by inflation, rising food demand, limited supply. Because here's the key idea. You cannot create more farmland. It is finite, and unlike financial assets, it produces something essential: food. And demand for food does not disappear during economic downturns. That gives farmland a unique advantage. It's not just a store of value, it's a productive asset. But now, let's be honest, because this is where nuance matters again. During the Great Depression, farmland values actually fell about 37%. Initially, farm income collapsed. Many farms were foreclosed, so this is not a short-term hedge. It does not spike during crisis like gold miners. Instead, it recovers and compounds over time, and historically, after downturns, farmland has gone on to grow significantly. Now let's talk about why most people don't own it, because this is important. Farmland is expensive, often thousands per acre, illiquid, hard to buy, sell quickly, mostly privately owned. Even today, the majority of U.S. farmland is owned by families and large investors. So for most people, it's simply not accessible. And that's why it remains underrepresented in portfolios. Asset 4. Consumer staples. Finally, we get to the most boring asset on this list: consumer staples. These are companies that produce everyday essentials: food, beverages, cleaning products, household goods. Not exciting, not trendy, but incredibly important. Because during a crisis, consumer behavior changes. People cut spending, they delay purchases, they avoid luxury, but they don't stop buying essentials. They still need food, soap, basic goods, and that creates stability. Let's look at the data. During the 2008 financial crisis, S&P 500 dropped about 37%. Consumer staples dropped only around 10 to 15%. That's a huge difference, because avoiding losses matters. If you lose 50%, you need 100% gain to recover. If you lose 15%, recovery is much easier. Even during the Great Depression, companies like Procter & Gamble continued operating and paying dividends. That's resilience. These companies don't explode. They don't double overnight, but they provide stability, cash flow, predictable demand, and that makes them valuable in uncertain environments. Why people ignore these? So now we have the full picture. 4 asset classes, clear historical patterns, real data. So the obvious question becomes, why doesn't everyone invest this way? And the answer has very little to do with logic and everything to do with human behavior. Because as humans, we are not wired for defensive thinking. We are wired for growth opportunity. Excitement. We chase what's going up. We follow trends. We pay attention to what's performing now, not what performs under stress. And that creates a blind spot, because assets that perform well during crises often underperform during bull markets. Gold miners are volatile. Bonds feel slow. Farmland is inaccessible. Staples are boring, so investors ignore them until conditions change. And by the time conditions change, it's often too late to reposition effectively. There's another layer to this: financial media. Most of what you see is focused on growth sectors, innovation, technology. Because that's what attracts attention. That's what drives clicks. But stability, protection, risk management, that's not exciting. So it's under-discussed. And over time, investors become conditioned to ignore it. If you've watched this far, you already see what most people don't. The market isn't one game. It's 2. The growth game and the survival game. Most people only learn one. And that's why they win during good times and lose everything during bad times. The people who build real wealth, they understand both. They position for both. and they don't wait for the crash to start thinking about it. Because by then, it's already too late. So now the question is simple. Which game are you playing? If this changed how you see investing, subscribe, like, and comment. Because this is the kind of thinking that separates average investors from the ones who stay ahead